Over the last quarter, from a global perspective, the most notable event was the Fed's entry into a rate-cutting cycle, with the initial cut of 50 basis points in September. The decision was targeted to provide a more balanced policy environment for the US economy. The market reacted positively overall. However, we believe it's important to know that we've entered a rate-cutting cycle with a backdrop of a very strong economy, indicated by strong services PMI, GDP growth, and a tight labor market. Our base case continued to be a soft landing for the US in the next 12 months, but a combination of rate-cutting cycle with a strong economy would suggest that the equilibrium rates will be higher than what the market previously anticipated. A higher discount rate could exert pressure on the expensive part of the market, such as chip makers and technology sector, as more distant cash flows are being heavily discounted. In the last quarter, we have increased US exposure in parts of the market that have not fully participated in the rally. And with the US economy remaining resilient, we believe that cyclical sectors such as equal-weighted SP 500 and quality small caps would offer more upside and less sensitivity to rates being higher for longer. Switching to our domestic share market, the narrative is somewhat different. Whilst we hold a more positive outlook for the US, our view on the domestic economy is considerably more cautious. We see several headwinds currently at play. First, domestic inflation continues to remain sticky, with rent inflation staying persistent due to the structural supply and demand imbalance. Second, our consumers remain weak due to high variable mortgage rates and savings that continues being depleted. Lastly, deflation and ongoing economic struggles in China further puts pressure in our export sector. At the same time, we do not see these risks being fairly priced in our market's current valuation, which remains at one standard deviation above the long term. We therefore recommend a cautious approach in domestic share market, focusing on recovery opportunities than an index approach. As inflation continues to trend lower in the US, market risk sentiment is shifting towards economical sensitivity, particularly around the health of consumers, resilience of the labor market, and the likelihood of a recession. While economical indicators are currently suggesting strength, but these ultimately are lagging indicators. In a scenario where the economy experiences a slowdown, we think government bond will provide the diversification and protection for capital. Unlike in 2022, where inflation uncertainty caused a positive correlation between bonds and equities, an economical shock would like to see these assets return to a more typical negative correlation. To hedge portfolios effectively, investors should not overlook bonds. In fixed income, we recommend a balanced allocation between treasuries and the high coupon-paying floating rate notes to provide a more rounded return profile and diversification to both inflation and economic uncertainty.